How does a 130-year-old steel and metal bender suddenly put up the kind of margin expansion you'd expect from, I don't know, a Silicon Valley software startup?
Right. It's wild.
That makes no sense on paper. But today, we're looking at a company that just quintupled its profits in 3 years. And, not by writing code, but by manufacturing some of the heaviest, most physical objects on Earth.
Yeah, literally the physical building blocks of the modern world.
Exactly. So welcome to this Talk Tickers edition of our Deep Dive. Our mission here, we are breaking down corporate earnings calls for retail investors. We take the raw data, we translate the Wall Street jargon into plain language, and we give you an opinionated, actionable bottom line for your portfolio.
Because you really have to cut through the noise with these industrial stocks.
You absolutely do. And today's subject is Carpenter Technology, ticker symbol CRS. We are tearing into their Q4 2026 earnings conference call. We've got the prepared remarks, the presentation data, and most importantly, the unscripted analyst Q&A session.
Yeah, and this particular call, it is just a fascinating case study. Because usually, when you analyze heavy industrial manufacturing, you are looking at a highly cyclical boom and bust business model.
Right, you're looking for the cyclical cliff.
Exactly. You expect tight margins, you expect massive debt loads, and this constant grueling struggle against the cost of raw materials. But Carpenter Technology is, they're currently operating in a completely decoupled reality.
Completely.
They supply the absolute critical specialty alloys, the titanium, the stainless steels to aerospace, defense, and medical markets. And what we're seeing in this transcript, honestly, it's a masterclass in what happens when you hold a structural monopoly on the exact physical materials that the world desperately needs right now.
The leverage they have is just almost unprecedented in the physical world. But before we get into the incredible financial numbers, we really have to start where this call started, which was on a very somber, very sudden note regarding the company's leadership.
Yeah, that was a shock.
It really was. The call opened with Chairman Tony Thien and CFO Tim Lane addressing the tragic passing of Brian Malloy.
Right.
And for investors who track management continuity, this was a massive shock to the system. Malloy had quite literally just taken over as the incoming CEO on July 1st of this year.
Yeah, just a few weeks prior.
Exactly. And he wasn't, a sudden outside hire. He had been with Carpenter since 2015, ran major segments of the business, and was universally viewed as the architect behind a lot of the strategic moves that are paying off right now.
The human element here is just tragic. And, the board found themselves in an incredibly difficult position.
Right.
Because from a purely analytical governance perspective, which, that's how a retail investor has to view this, the immediate question is always about operational continuity.
Because usually it causes chaos.
Oh, absolute chaos. When a CEO passes away suddenly or is removed, you typically see a board scramble. They appoint a temporary interim CEO who basically just, keeps the seat warm.
Right, while they hire some fancy search firm.
Exactly. They launch a massive 6-month-long external search process, and that creates half a year of strategic paralysis. Competitors pounce, employees get nervous, and large structural customers like Boeing or Airbus, they hesitate to sign long-term deals.
Well, that is not what happened here.
Oh.
Tony Thien, who had been the CEO for years and was transitioning to executive chairman, he stepped right back into the CEO seat.
Seamlessly.
And the language he used on the call, it was highly deliberate. He didn't say, I'm just holding down the fort. He explicitly stated, and this is a quote, "This is not an interim assignment, and we are not launching an external search for a new CEO. The plan is for me to remain a CEO for an indefinite period of time."
Which is such a strong signal.
It really is. I look at that and I see a board that understands the fragility of momentum. They completely short-circuited any instability narrative. The architect of the current strategy is back at the helm, which means for you, the investor, the thesis remains entirely uninterrupted.
I completely agree with that assessment. The Mourin has immense credibility with Wall Street and, honestly, more importantly, with Carpenter's massive aerospace customers.
Right, the people actually buying the metal.
Exactly. By removing that interim label, he signals to Boeing, to GE Aerospace, that Carpenter is fully authorized to make decade-long capital commitments right now. There's no waiting for a new regime. And as we dig into these numbers, you'll see exactly why they cannot afford to waste a single month on executive transitions.
No, the demand curve they are riding is it requires immediate execution. So let's get right into that demand curve and the raw numbers, because the data for the fourth quarter of fiscal year 2026 is staggering.
It really is off the charts.
Okay, get this. Operating income came in at $206.9 million.
Wow.
Just to contextualize that momentum, that is an 11% sequential increase, meaning up 11% just from the third quarter, and a massive 37% jump year over year.
37% on industrial metal.
Yeah. But you really have to zoom out to appreciate the scale. For the full fiscal year 2026, operating income hit $702 million, up 34% from 2025.
And if you go back to, 2023?
Right. If you go back to fiscal year 2023, they were hovering around the 140 million mark. They have orchestrated a five-fold increase in operating income in 36 months.
That multiplier is what makes this such a unique industrial story. A five-fold increase usually requires, a massive debt-fueled acquisition spree.
Right, where you just buy three competitors to fake top-line growth.
Exactly, artificially juicing the numbers. But Carpenter achieved this organically. It all trickled down to the bottom line flawlessly. Q4 diluted earnings per share landed at $3.23.
It was a huge beat.
It is. Now, we should note for accuracy that CFO Tim Lane did point out a slight optical boost to that EPS number.
Oh, the tax thing.
Yeah, they had a lower than expected effective tax rate of 20.7% in the quarter, driven by some discrete tax benefits tied to equity awards. But honestly, even if you normalize the tax rate, the core earnings engine is running at a record pace.
The tax benefit is just a nice rounding error on top of an already massive beat. The real story here is the underlying profitability of their manufacturing base.
Yeah, the margins are where this gets crazy.
Absolutely. So Carpenter is divided into two main reporting segments. There's PEP, which is Performance Engineered Products, and then there's the giant beating heart of the company, SAO, or Specialty Alloys Operations.
The big foundry stuff.
Right. This segment is their major premium alloy and stainless steel manufacturing. In the fourth quarter, the SAO segment generated an adjusted operating margin of 37.8%.
Yep, there's that software margin.
When I read that number in the transcript, my immediate instinct as an investor was, honestly, deep skepticism.
Because it breaks the conventional models for heavy manufacturing. You just don't see it.
You absolutely do not get software-like margins in a massive capital-intensive foundry without cheating somewhere. Usually, when a steel or specialty metal company suddenly posts a high 30s operating margin, it means management is cannibalizing the future to impress Wall Street today.
Yeah, they're cutting corners.
Exactly. It means they're deferring critical maintenance, they're running the furnaces past their safe lifespans, they're slashing the R&D budget. They're essentially setting up the next CEO for a catastrophic capital expenditure cliff where the whole factory just breaks down. I look at 37.8% and I wonder, when does the bill come due?
And that is exactly the right lens to use. Margin expansion driven by deferred costs is a classic value trap. But the data Tim Lane provided completely undercuts that bearish theory.
Because he actually brought up the maintenance schedule.
He did. If they were playing games with the maintenance schedule, they would try to hide it. Instead, Lane explicitly called it out when providing guidance for the upcoming first quarter of fiscal 2027. He noted that their Q1 guidance fully bakes in elevated preventative maintenance levels.
Elevated, not deferred.
Right. He emphasized that this is a traditional planned operational rhythm for their first fiscal quarter. They are actively scheduling downtime. They are deliberately taking their most profitable, highest yielding machines offline, cooling them down, and doing the heavy restorative work required to keep them running at peak efficiency.
That detail changes the entire complexion of the 37% margin. It means they aren't skipping the oil changes, on a massive industrial scale. They are taking the margin hit to do the maintenance, and they are still modeling record profitability.
It's structurally sound.
So if we rule out accounting tricks and deferred maintenance, we have to look at the physical realities of how they are actually doing this. Management cited three drivers: productivity gains, product mix optimization, and aggressive pricing realization. Let's start with productivity, because in a heavy industrial setting, productivity doesn't mean having fewer Zoom meetings.
No, it has a very specific physical definition.
Right. What does it actually mean for a foundry?
In the specialty alloy business, productivity is almost entirely synonymous with one word: yield.
Yield. Okay.
To understand this, you have to picture the manufacturing process. Carpenter isn't just pouring liquid metal into a basic mold. They are creating incredibly complex, exotic alloys. We're talking mixtures of titanium, nickel, cobalt, and chromium.
Stuff that's incredibly hard to work with.
Extremely hard. These materials are melted in massive vacuum arc remelting furnaces. They have to do it in a vacuum to prevent any contamination from the ambient air. Then they are forged under thousands of tons of pressure. It is a violent, highly volatile process. And historically, in this industry, a significant portion of a massive metal ingot might end up with microscopic imperfections or thermal stress fractures.
And you can't put a fractured piece of metal into a jet engine.
Exactly. That defective portion has to be chopped off and thrown back into the scrap pile to be melted again.
Which is just a massive waste of time and energy. You've essentially paid to heat and forge the exact same metal twice.
Right. Every time you have to scrap and remelt, your energy costs double, your labor costs double, and your total throughput drops.
Yeah.
What Carpenter has achieved through relentless operational discipline over the last few years is a structural improvement in their first pass yield.
Meaning they get it right the first time.
Exactly. More of the metal they melt the first time ends up meeting the microscopic tolerances required by the aerospace industry and goes straight out the door as a finished, sellable product. When you improve yield, that cost savings drops directly 100% to the operating margin line.
So they're doing more with the exact same physical footprint and the exact same energy inputs. Okay, that perfectly explains the productivity piece. The second driver they mentioned is product mix optimization.
This is a huge one.
Yeah, I look at their factory footprint and I see it as a finite amount of thermal capacity. Right. A furnace can only be hot for 24 hours a day. They have to decide what to put inside it. In the past, they might have filled that furnace with relatively basic, commoditized stainless steel just to keep the factory running and cover fixed costs.
Just to keep the lights on.
Exactly. But what this transcript indicates is that they are actively rejecting lower margin work.
They are treating their thermal capacity like prime real estate. If you own a high-end commercial building in Manhattan, you don't lease it out to a dollar store.
Right, you want a luxury brand.
Exactly. You lease it to a flagship brand. Carpenter is looking at their order book, which is overflowing right now, and they are allocating their furnace time exclusively to the highest complexity, most mission-critical alloys.
Like the engine parts.
Yeah, we are talking about proprietary superalloys designed for the hot section of a jet engine. Materials that literally only Carpenter and maybe one or two other companies on Earth have the metallurgical recipes and the FAA certifications to produce. The margins on those specialized products are astronomical compared to basic structural steel. By optimizing the mix, they are extracting the maximum profit from every single hour a furnace is turned on.
And that flows directly into the third driver, which is pricing realization. When you are dedicating your factory to the most critical materials, and you are one of the only suppliers with the capacity and the certifications to deliver, you possess absolute pricing power.
You hold all the cards.
You do. You aren't negotiating with Boeing or General Electric based on the spot price of raw nickel. You are negotiating based on the value of a completed jet engine.
Right, because if they don't buy your alloy, they can't ship a $50 million engine.
Exactly. That gives Carpenter the leverage to push massive price increases through the system.
And they have exercised that leverage aggressively. But what makes this thesis so durable for you as an investor is that the margin expansion isn't reliant solely on price hikes. It's a three-legged stool.
Right. Yield, mix, and price.
Yeah. Even if pricing power were to moderate slightly, their internal yield improvements and their high-value product mix provide a permanent structural floor to their profitability that simply didn't exist 3 years ago.
Which brings us to the core demand drivers. We know the margins are structurally sound, and we know they are extracting maximum value from their capacity. But we have to look at the end markets to understand why the demand is so intense right now. The story behind these numbers is essentially a collision of macroeconomic megatrends.
It really is a perfect storm.
Starting with their largest end market, aerospace and defense. Overall, A&D sales were up 17% year over year. But when you break down the submarkets within aerospace, the growth rates are staggering. Aero engines were up almost 30% year over year. Fasteners were up 10% sequentially from just the previous quarter. Structural distribution was up 25% sequentially.
Massive numbers.
Let's isolate the engine market first. Why is demand for engine alloys up nearly 30% in a single year?
It is a combination of technological evolution and a massive aftermarket crisis. On the technology side, consider the evolution of commercial jet engines over the last 2 decades. The industry has moved toward next-generation engines, like the CFM, LEP, to achieve the extreme fuel efficiency airlines demand. These new engines have to operate at much higher internal temperatures.
Like temperatures that would melt a normal car engine.
Oh, temperatures that routinely exceed the melting point of standard aerospace metals.
So how does the engine not melt itself mid-flight?
By using incredibly advanced, highly engineered materials. The turbine blades in the hot section of these engines are often grown as single crystal superalloys. They're coated with thermal barriers, and they're riddled with complex internal cooling channels. Carpenter provides the raw, ultra-pure base materials, the high nickel and cobalt alloys required to forge these components.
So every new engine just needs way more of this exotic stuff.
The sheer volume of high-end alloys required per engine has increased dramatically with this new generation of aircraft.
But it's not just building new engines that is driving this 30% spike, right? It's the fact that these new engines are wearing out faster than expected.
Precisely. This is the aftermarket crisis I mentioned. Because these next-generation engines run hotter and under more physical stress, the components are degrading faster in the field than the initial engineering models predicted.
Which the airlines hate.
They despise it. Airlines are being forced to pull planes out of service for heavy engine maintenance much earlier in their life cycles. This creates a massive, unplanned surge in demand for replacement parts in the MRO space. That's maintenance, repair, and overhaul.
So Carpenter's getting hit from 2 sides.
Exactly. They are getting desperate orders from engine manufacturers who are trying to build new engines to satisfy Boeing and Airbus, while simultaneously trying to manufacture spare parts to keep the existing global fleet in the air.
That dual front demand perfectly explains the 30% spike. But then we have the fastener market, which was up 10% sequentially. I think, the average investor hears fasteners and they picture a bin of cheap screws at a hardware store. It sounds like a low-margin commodity. Why is Carpenter so excited about fasteners?
Well, an aerospace fastener is a marvel of engineering. We are not talking about wood screws. We're talking about highly specialized titanium and superalloy bolts and rivets that hold together the structural frame of a commercial jet under immense atmospheric pressure and extreme temperature fluctuations.
Right, going from ground temperature to negative 60 degrees in the air.
Exactly. And there can be over 1 million individual fasteners on a large wide-body aircraft. They are life-critical components. If a fastener fails, the structural integrity of the airframe is compromised.
So they have to be perfect.
They have to be flawless. Because of the sheer volume of fasteners required per plane, as Boeing and Airbus attempt to ramp up their monthly aircraft production rates, the demand for fastener stock material scales exponentially.
And Carpenter provides the highly specific certified alloy rods and wires that the fastener companies use to actually machine those million little bolts.
That makes perfect sense. Okay, so aerospace is clearly booming across every subsegment, but the metric that really caught my eye in this transcript wasn't airplanes at all. It was their industrial and consumer end market.
Yeah, this was the sleeper hit of the quarter.
Sales in this segment were up 22% year over year and 19% sequentially. Now, on the surface, industrial and consumer sounds incredibly broad. Are they selling more metal for, washing machines? No, not quite washing machines.
All right, because Tony Thien highlighted a very specific, surprising driver for this massive growth, and it's the semiconductor industry.
This is one of the most underappreciated aspects of Carpenter's business model. Most retail investors trying to play the semiconductor or AI boom, what do? They buy NVIDIA or maybe ASML or Taiwan Semiconductor.
Right, they buy the tech stocks.
They don't look at a 130-year-old Pennsylvania steel company.
Right.
But the connection is undeniable. The manufacturing of a modern semiconductor, the actual process of etching microscopic circuits onto a silicon wafer, is one of the most chemically and thermally violent manufacturing environments ever created by humans.
The fabrication facilities, the fabs, they use incredibly aggressive materials, right?
Extremely aggressive. They use highly corrosive plasma gases, extreme temperatures, and ultra-high vacuums. The physical machines that execute these processes, the deposition chambers, the etching equipment, the fluid delivery systems, have to be built out of materials that absolutely will not degrade.
Because if they do degrade,
if a valve or a chamber wall made of standard steel corrodes inside a fab and drops a single microscopic particle of rust or contamination onto a silicon wafer, it doesn't just ruin one chip, It ruins an entire batch, which can cost the fab millions of dollars in lost yield.
Wow. So the physical infrastructure of the AI revolution requires virtually indestructible metallurgy.
Exactly. The components inside these semiconductor manufacturing machines require Carpenter's highly specialized, ultra-high purity, corrosion-resistant alloys. And we are currently in the middle of a massive global boom in fab construction.
Because of all the government subsidies in the AI arms race.
Right. Massive subsidies aimed at onshoring semiconductor supply chains. Companies are spending hundreds of billions of dollars building new fabs around the world. Every single one of those fabs requires thousands of miles of ultra-pure fluid delivery lines, thousands of specialized valves, and hundreds of massive processing chambers. Carpenter is quietly acting as the primary supplier of the critical picks and shovels for this global semiconductor gold rush.
It is a brilliant, hidden growth story. It demonstrates that their advanced materials aren't just tethered to aviation. They are fundamental to the physical infrastructure of advanced computing. Now, speaking of advanced materials, there is a data point in this transcript that could severely trip up an investor if they aren't paying close attention.
Oh, the pricing metric.
Yes, I'm calling it the pricing paradox. We just established that Carpenter has unprecedented demand from aerospace and semiconductors, and we established they have massive pricing power. Yet, if you look closely at the presentation slides, the reported average base price per pound for the SAO segment actually decreased.
Which looks terrible on the surface.
It looks awful. If demand is through the roof and capacity is constrained, how on earth is their average price per pound going down? I mean, here's my analogy. If you're the bouncer at the hottest club in town and there's a line around the block, you raise the cover charge. You don't lower it. So are they secretly discounting their products?
I'm glad you brought this up because CFO Tim Lane actually spent time on the call preemptively explaining this exact metric. It is a classic example of how raw financial data can be deeply misleading without operational context.
Right.
The decrease in the average price per pound has absolutely nothing to do with a loss of pricing power or discounting. It is purely a mathematical artifact caused by volume mix.
Okay, break that math down for me because it sounds counterintuitive.
It comes back to that massive 22% year-over-year volume growth in the industrial sector we just discussed, the semiconductor and fab materials. Those industrial alloys, while highly specialized and incredibly profitable, tend to be physically denser and heavier than the exotic, lightweight titanium alloys they sell into the aerospace engine market.
Okay.
So you have a scenario where Carpenter dramatically increased the total tonnage of metal they shipped in the quarter, but a disproportionately large chunk of that new volume was this heavier industrial material.
I see. Because the metric is price per pound, the heavier material skews the denominator.
Precisely. Imagine you sell 1 pound of titanium for $50, and you sell 10 pounds of specialized industrial steel for $10 a pound. Your total revenue is $150 across 11 pounds. Your average price per pound is around $13.60.
Okay, following.
Now, imagine next quarter, your titanium sales stay exactly the same, but your industrial steel sales explode to 20 pounds. Your revenue goes up to $250 across 21 pounds. Your average price per pound just dropped to $11.90.
Wow.
The price per pound went down, but your total revenue and total profit went up massively. Lane was adamant that these heavier, lower price per pound products carry comparable, exceptional profit margins to the rest of the portfolio.
So they're making the exact same percentage profit on every dollar of revenue. The product just physically weighs more.
Exactly. The fact that their overall operating margin hit a record 37.8% is the ultimate proof that the underlying pricing power is fully intact.
That is a crucial distinction. It really highlights why you can't just run a stock screener on basic metrics. You have to understand the physics of the product being sold. Now, let's transition back to the aerospace market, because Tony Thien highlighted a phenomenon during his prepared remarks that I found completely fascinating.
The cautious customer dynamic.
Yes. He described a specific dynamic with their structural aerospace customers, the Tier 1 and Tier 2 suppliers who buy metal from Carpenter, machine it into airplane parts, and then sell those parts to Boeing or Airbus. Ager noted that despite Boeing's massive public push to ramp up production to chew through a backlog of, 16,000 aircraft?
16,000, yeah.
Despite that, many of Carpenter's structural customers are currently ordering below expected demand rates out of an abundance of caution. I look at this and I see a supply chain suffering from severe post-traumatic stress.
Post-traumatic stress is the perfect way to describe the psychology of the aerospace supply chain right now. To understand why these suppliers are intentionally ordering below demand, you have to look at the brutal history of the last 5 years. These smaller structural suppliers have been burned repeatedly by Boeing's inability to maintain a consistent production schedule.
Right, you go back to 2019 with the 737 MAX groundings. Boeing told the supply chain to keep producing parts and then suddenly halted the assembly lines.
And the suppliers were left holding the bag. They had spent hundreds of millions of dollars buying raw titanium and steel from companies like Carpenter. They paid the labor to machine the parts, and then Boeing just refused to take delivery.
That destroys your working capital.
It nearly bankrupted several of them. They were trapped with massive illiquid inventory stockpiles. Then came the pandemic, which shattered demand entirely. And just as they started to recover and ramp up again, the Alaska Airlines door plug blowout happened earlier this year.
Which triggered FAA investigations, production caps, and now massive labor strikes at Boeing.
So these Tier 1 and Tier 2 suppliers have essentially become cynics. They are playing a massive game of chicken with Boeing. Boeing puts out a press release saying, "We are going to build 47 or 52 narrow-body planes a month." And the supply chain looks at them and says, "Prove it."
Right. We're not buying the metal until we see it.
Exactly. We are not buying the raw metal and tying up our working capital until we actually see those planes rolling off the assembly line consistently.
So they're intentionally drawing down their own internal buffer inventories rather than placing new orders with Carpenter. But this cautious behavior creates an incredibly volatile setup for the near future.
Which I call the coiled spring dynamic.
Because Boeing absolutely has to build those planes eventually.
Boeing, despite all their issues, absolutely must ramp up production. The airlines are desperate for new fuel-efficient planes.
Yeah.
When Boeing finally stabilizes their assembly lines and sustains that higher production rate, these structural suppliers are going to be caught totally flat-footed.
Because they've depleted their own safety stock playing chicken.
Precisely. They will suddenly realize they don't have the raw material on hand to meet Boeing's actual production cadence. They are going to have to turn around and place massive panic-driven orders with Carpenter Technology to try and catch up.
It will trigger a massive bullwhip effect up the supply chain.
And the problem for those suppliers is that Carpenter is already running near full capacity.
Tony Thien even noted that they are already seeing the leading edge of this panic. He mentioned that for an increasing number of structural customers, they are seeing accelerated ordering and extending lead times. As that caution fades and turns into desperation, the demand is going to accelerate violently.
Which is a great problem for Carpenter to have, but still a problem.
Right, which leads to the most critical operational question of this entire deep dive. If the structural customers are about to flood the order books, and the engine manufacturers are already begging for more material, and the semiconductor fabs are demanding alloys, how on earth does Carpenter plan to physically manufacture all this metal? They are constrained by physics. You can't just download a new furnace from the cloud.
No, you can't. And this is where the analysis transitions from looking at current backward-looking performance to evaluating management's capital allocation and future earning power. The physical constraint is the central challenge, and management's answer to this challenge is what makes their long-term guidance so compelling.
Let's lay out that guidance first so everyone has the numbers. For the immediate fiscal year 2027, management is projecting $850 million to $880 million in operating income.
Which is massive.
To put that in perspective, that represents a 21 to 25% growth over the record-breaking FY26 they just completed. And for the first quarter of FY27, they guided for $195 to $200 million. Which is a 27 to 30% increase over the same quarter last year.
And it's really worth noting Tony Thien's tone when discussing this near-term guidance.
Yeah, he was confident.
Confident is an understatement. During the Q&A, an analyst asked if the growth rate might moderate or if there are any hidden headwinds. The DIN was borderline defiant. He essentially told the analyst community, if you want to consider this guidance as the absolute floor for FY27, you won't get any pushback from me.
Wow.
He made it very clear that Carpenter does not set guidance targets they merely hope to achieve. They set numbers they have extremely high confidence they can hit based on their current order book, and then they dedicate the rest of the year to finding operational efficiencies to blow past those numbers.
It is a level of swagger you rarely see from an industrial CEO. But then they threw out a long-term target for fiscal year 2029 that really forced Wall Street to recalibrate their models. Management stated they are targeting $1.2 billion to $1.3 billion in operating income by FY 2029.
That's a 20% CAGR.
Exactly, a 20% compound annual growth rate over the next 3 years. A 20% CAGR in a heavy manufacturing business is almost statistically impossible unless you are drastically extending your physical capacity. Which brings us back to the physics problem. How do they melt enough metal to generate $1.3 billion in profit?
The answer lies in their massive capital project in Athens, Alabama,
which they refer to as a brownfield expansion. And I think it's critical we differentiate this for investors because how a company chooses to expand dictates their entire risk profile. Why are they doing a brownfield expansion instead of building a shiny new factory somewhere else?
The difference between a greenfield expansion and a brownfield expansion is the difference between a highly speculative gamble and a calculated high-probability investment.
A greenfield project means you buy an empty greenfield, right?
Right. You are starting from absolute scratch. You have to negotiate with local governments for zoning, you have to run high-voltage power lines to the site, lay water and gas infrastructure, pour massive concrete foundations, and build the physical structures before you even install a single piece of manufacturing equipment.
Sounds like a nightmare.
Greenfield projects in heavy industry are notorious for taking 5 to 10 years, running hundreds of millions of dollars over budget, and getting bogged down in environmental permitting.
It's a massive drag on free cash flow with no guaranteed return on the timeline.
Exactly. A brownfield expansion, on the other hand, means you are adding new capacity to an existing facility that is already fully operational. Carpenter operates a massive campus in Athens, Alabama. The heavy infrastructure is already in place. The massive power grid connections required to run vacuum arc furnaces are already hooked up.
They already have the permits.
The environmental permits for industrial melting are largely secured. They have an existing trained workforce in the region. By choosing a brownfield expansion, Carpenter is essentially just building an addition onto an already functioning house. They are installing new furnaces and forging presses on a site they already control and understand deeply.
The risk mitigation is enormous. It is faster, drastically cheaper, and insulated from the worst macro construction delays. And CFO Tim Lane confirmed the timeline on the call. He stated the Athens expansion is currently on budget and on schedule. The heavy construction is already underway. Key long lead time equipment is arriving on site, and they expect it to be mechanically complete and beginning production by early fiscal year 2028.
And the financial modeling for this expansion is highly accretive. Management projects that once the Athens brownfield expansion is fully operational and qualified, it will add approximately $150 million in incremental operating income to the company's run rate by fiscal year 2030.
But this timeline brings up a classic, almost existential fear for industrial investors. Analyst Andre Madrid from BTI actually pressed management on this during the Q&A.
Oh, the peak cycle question.
Yes, because if Carpenter is projecting $1.2 to $1.3 billion in operating income in 2029, right as this new massive supply of metal comes online from the Athens facility, what does this mean for the macro cycle?
Right, it's a huge concern.
In cyclical industries like metals or semiconductors, investors are terrified of buying the stock right as a company brings new capacity online. Because historically, that new capacity floods the market, destroys pricing power, and triggers a massive cyclical cliff in earnings. Madrid essentially asked, are you just modeling peak earnings for 2029 and setting us up for a crash in 2030?
It is the single most important question a long-term investor can ask about an industrial stock. And Tony Thien's response was categorical and highly structural. He stated unequivocally that fiscal year 2029 is not the peak of their earnings cycle.
He gave 2 reasons for that, right?
He provided 2 structural arguments for why the runway extends well into the 2030s. First is the mechanical reality of the aerospace industry. When you install a new furnace, you can't just start melting titanium and shipping it to Boeing the next day.
Because of the regulations?
The aerospace industry requires a rigorous, multi-year qualification process for new manufacturing equipment. Every single alloy that comes out of the new Athens facility will have to be tested, validated, and certified by the FAA and the engine manufacturers.
Meaning the facility will ramp up very slowly and methodically.
Exactly. Thian pointed out that the Athens facility will still be in the early to middle stages of its production ramp in 2029. It will not hit its maximum run rate of profitability until 2030. 2030 or 2031. So that $1.3 billion target for 2029 isn't even fully reflecting the massive new capacity they are building. It is not the top of the mountain, it's a base camp on the way up.
And the second argument is the underlying macro demand, which ties back to the megatrends we discussed earlier. The OWN pointed out that 80% of their revenue comes from aerospace, medical, and industrial gas turbines.
Massive secular trends.
When you look at the 16,000 aircraft backlog globally, it will take Boeing and Airbus a decade just to build the planes that have already been ordered, let alone future demand. When you look at the aging global population and the compounding need for titanium joint replacements and spinal implants in the medical sector, when you look at the massive, insatiable energy demands of AI data centers requiring next-generation industrial gas turbines for power generation.
These are not cyclical 3-year blips.
No. These are decades-long structural megatrends. Management does not see a cyclical cliff. They see a demand plateau that simply continues to slope upward.
The visibility they have into their order book extends further than almost any other industrial company in the market right now.
So, if we accept that they are going to reliably generate well over $1 billion in operating income annually, we have to look at the final piece of the puzzle, capital allocation, because operating income is just an accounting metric. It is not cash in an investor's pocket. For a retail investor, capital allocation is where management proves their competence.
Absolutely.
A company can generate $1 billion in profit, but if the CEO decides to blow it on a terrible, ego-driven acquisition, the stock will plummet. We have to look at their balance sheet and their statement of cash flows. And frankly, Carpenter's cash generation is operating at an elite level.
It really is. In fiscal year 2026, they generated adjusted free cash flow of $362.3 million. And it is vital to understand that they achieved that number after spending over $240 million on capital expenditures, the vast majority of which went toward funding the massive Athens brownfield expansion.
That is the holy grail of industrial finance. They are completely self-funding a massive generational capacity expansion out of their own daily cash flow.
Right, without needing to go to the bond market.
Without issuing dilutive equity and without taking on crippling debt.
For fiscal year 2027, they are guiding for free cash flow to accelerate to between $400 million and $430 million. And you highlighted a critical metric regarding this cash flow in your notes, the cash conversion rate. They are operating with an 85 to 90% cash conversion rate.
Yeah, that stood out to me.
For you listening who might not track that specific metric, it is a crucial indicator of financial health. Cash conversion rate is essentially the percentage of a company's accounting profit, their net income or operating income, that actually translates into cold, hard cash in the bank account at the end of the quarter.
Right, because sometimes a company can report massive accounting profits. But if you look under the hood, all that money is tied up in unsold inventory sitting in a warehouse or unpaid invoices from customers who are stretching their payment terms. Their profit looks great on paper, but their actual cash flow is terrible.
Exactly. Maintaining an 85 to 90% cash conversion rate in a heavy, capital-intensive manufacturing business is phenomenal. It proves that their profits are real, not just accounting adjustments. It proves they are managing their working capital. They are collecting cash from customers quickly and turning over their inventory efficiently.
And this massive cash generation has fortified their balance sheet. Total liquidity currently sits at $892.4 million. Their net debt to EBITDA ratio is well below 1x. They have almost no dangerous leverage.
They're bulletproof.
They're effectively bulletproof against a high interest rate environment because they don't need to borrow money. But this creates a high-class problem for management. What do you actually do with almost $1 billion in liquidity and $400 billion in fresh cash coming in every single year? How are they returning that value to the investor?
Well, they are utilizing a very disciplined, balanced approach to shareholder returns. In fiscal year 2026, they repurchased $179.1 million of their own shares.
Which is huge.
Buying back stock is a highly tax-efficient way to return capital. It reduces the total outstanding share count, which means every remaining share held by you, the investor, instantly represents a larger ownership stake in the company and a larger claim on future earnings. Furthermore, they still have $119 million left on their current $400 million share buyback authorization.
So the buying pressure will continue.
Yes. They also paid out $40.3 million in dividends, providing a steady yield for income-focused investors.
But what about acquisitions? This is where my cynical investor brain always kicks in. You give a CEO a fortress balance sheet and $1 billion in liquidity, and they usually get bored. They want to buy a competitor. They want to build an empire. Did any analyst press them on M&A during the call?
Yes. Andre Madrid from BTI asked exactly that. With all this cash piling up, is M&A on the table? And Tony Thiene's response was incredibly refreshing for a shareholder. He didn't completely rule it out. He noted that they evaluate everything that comes across their desk. But he essentially outlined a philosophy that makes large-scale M&A highly unlikely.
Right.
He argued that when a company has internal organic growth projects in front of them that are as attractive and low risk as the Athens brownfield expansion, it is almost impossible to mathematically justify the immense risk and integration headaches of buying another company.
I wrote down his exact quote because it was so definitive. He said, "When I can control my own destiny, the risk profile is much better for me. I don't want to buy M&A just to buy something." That is exactly what you want to hear. He is not empire building to inflate his own ego or salary. He is hyper-focused on maximizing the return on capital employed by investing in assets and facilities he already owns and knows how to operate flawlessly.
It is a textbook example of disciplined capital allocation in a cyclical industry. But there is one more massive hidden catalyst regarding their future cash flows that we absolutely have to discuss.
Oh, I'm going to say.
It was buried in a back and forth during the Q&A, but it might be the most exciting leading indicator in the entire transcript. I'm talking about the LTA repricing catalyst.
Yes. Gautam Khanna from TD Cowen zeroed in on this. He asked management about the status of their long-term agreements, or LTAs. To give you context, in the aerospace supply chain, business isn't conducted on a month-to-month basis. A company like Carpenter signs a long-term agreement with a major customer, like GE Aerospace or Pratt & Whitney.
Right, they lock it in.
This contract dictates the specific volume of alloy Carpenter will supply and the exact price they will charge over a multi-year period, usually 3, 5, or sometimes even 10 years.
The LTA structure is designed to guarantee predictable revenue for Carpenter and guarantee secure supply for the engine manufacturer. But consider how drastically the macroeconomic environment has changed over the last 5 years. We have experienced unprecedented global inflation. The cost of labor has skyrocketed. The cost of energy to run massive furnaces has surged.
And the underlying spot prices for raw materials like nickel and cobalt have been wild.
Highly volatile. So if Carpenter signed a 5-year LTA in 2019, right before the pandemic, the price they agreed to charge is now wildly below the current market reality. They have essentially been subsidizing their customer supply chain by eating those inflationary costs on those older contracts.
Exactly. And Gautam Khanna asked a very pointed question. Are there still pre-COVID contracts on the books that haven't been renewed yet? And Tony Thiene admitted that yes, there are still 1 or 2 major pre-COVID contracts that are finally coming up for renewal over the next 12 to 24 months.
The financial implications of this are massive. When those 2019 contracts expire and are renegotiated in today's market, Carpenter isn't going to raise the price by a standard 3 or 4% annual bump.
They're going to catch up all at once.
They're going to force a massive step function price increase to immediately catch up with 5 years of cumulative global inflation, plus the current massive scarcity premium for aerospace materials. Because Carpenter's fixed costs are already covered by their current operations, that step function price increase on these renewed LTAs is going to flow almost entirely, 100%, straight to the operating margin line.
It is an automatic, massive tailwind to their profitability that is already baked into the calendar.
But the dynamic gets even better for Carpenter. When asked about their negotiating position and their overall market share in these new LTA discussions, Thiene dropped a massive hint about their dominance. He said, and I quote, "Every contract in the aerospace side that we're working on, they ask for more and more material, not less."
Wow. They're basically dictating terms.
The customers aren't just accepting the massive price hikes, they are simultaneously begging Carpenter to increase the total volume guaranteed in the contract. They are asking Carpenter to take a higher percentage of their total supply needs, effectively pushing weaker competitors out of the market.
It is the ultimate manifestation of pricing power. Customers are so terrified of not having enough material to build engines that they are actively consolidating their supply chains around the one or two players, like Carpenter, who possess the financial stability and the physical capacity to actually deliver.
It cements their market share for the next decade at significantly higher margins.
Okay, we have systematically broken down the raw numbers. We've explored the structural megatrends driving demand across aerospace and semiconductors. We've analyzed their disciplined brownfield capacity expansion, and we've reviewed their elite cash generation and capital allocation strategy. It is time for the Talk Ticker's bottom line. We promised an actionable, opinionated take. Based on the totality of this data, is this a bullish or bearish signal for an investor evaluating Carpenter Technology?
If you look at the fundamental realities of their operational execution and their end markets, the data points in one very clear, undeniable direction.
I will deliver the definitive verdict right now. This transcript is a fiercely, unequivocally bullish signal for investors who are considering entering a position or currently holding the stock.
The investment thesis here is remarkably clean, which is rare in heavy industry.
It really is. The primary takeaway is that Carpenter Technology has effectively decoupled from the typical boom and bust manufacturing cyclicality. They are no longer a passive participant riding a macroeconomic wave. Their physical capacity is so critical that they are essentially creating the weather in the aerospace supply chain.
They have all the leverage.
They possess massive, undeniable pricing power driven by a structural physical supply shortage in their end markets that cannot be resolved quickly. Their margin expansion hitting that 37.8% mark is not a financial illusion. It is driven by relentless internal yield improvements and product mix optimization, which provides a permanent floor to their profitability.
And crucial for long-term holders, you have a management team that is behaving like true, disciplined stewards of capital. They are generating massive free cash flow. They are completely self-funding a highly accretive, low-risk capacity expansion in Alabama. They are explicitly rejecting the temptation of risky empire-building M&A, and they are aggressively returning excess cash directly to shareholders through significant buybacks and dividends.
It is a textbook masterclass in how an industrial company should be operated during a supercycle.
Yeah.
But before we sign off, I want to leave you with a final provocative thought, a thread to pull on for your own independent research that builds on everything we've discussed today, but looks slightly over the horizon.
Throughout this deep dive, we have focused heavily on the SAO segment and the aerospace market because that is the massive engine currently pulling the train. But if you dig into the transcript, you should look very closely at their smaller reporting segment, PPP, the Performance Engineered Products segment. The PP segment often gets entirely overshadowed by the sheer scale of SAO, but there are highly disruptive technological shifts happening within that portfolio.
Specifically, look at their Dynamite titanium business. During the call, management casually mentioned a massive strategic pivot. Dynamite historically used to be highly reliant on aviation. It was roughly 60% aerospace. But management noted that they have systematically flipped its customer base. Dynamite has transitioned into a heavily medical-focused business.
Right, a totally different end market.
They are supplying the ultra-pure titanium required for orthopedic implants, surgical tools, and advanced medical devices. And concurrently, within that same segment, their additive manufacturing business, which is essentially the high-end 3D printing of complex metal components, is catching fire in a completely different frontier, and that's the space sector.
We are talking about defense applications, satellite infrastructure, and commercial space exploration rockets. These applications require geometries and alloys that cannot be traditionally forged. They have to be 3D printed.
Exactly. So here is the thought to mull over for your portfolio. Right now, the broader market and Wall Street analysts value Carpenter Technology almost exclusively as a legacy aerospace supplier. Their valuation multiple is heavily tethered to Boeing's monthly aircraft build rates. But what happens if, over the next 3 to 5 years, the market wakes up and realizes that Carpenter holds a rapidly growing monopoly on the critical, specialized materials required for next-generation space tech and high-end med tech?
A total re-rating.
If Wall Street stops valuing them as a traditional industrial metal bender and starts pricing them as a critical infrastructure play for the space economy and advanced medicine, how dramatically could their valuation multiple expand?
It presents a fascinating re-rating potential. If the market fundamentally shifts how it categorizes the stock, moving it from a cyclical industrial multiple to an advanced materials or infrastructure multiple, the upside to the share price could be substantial, completely independent of the massive earnings growth we've already modeled.
It is a dynamic you absolutely must keep a close eye on. Because while the rest of the market is obsessively watching the airplanes, Carpenter Technology might just be quietly building the rockets. Thank you for joining us for this specialized, data-driven deep dive into the Carpenter Technology earnings call. We hope we've helped translate the Wall Street jargon into clear mechanics, given you an X-ray view into what makes this industrial powerhouse pick, and provided actionable context for your portfolio. Until next time, keep digging into the data and keep questioning the narrative.